Hey, vetted VA, it's Hammer coming to you this week with your mortgage market update. It is July 26, 2023, and this week I am joined by one of our real estate agent partners at Vetted VA, Alexis Brown. Alexis, please take a minute and tell everybody about yourself.
Hello, everyone. My name's Alexis Brown. I am a VVA4 serving West Tennessee. Happy to be here.
You're in Tennessee, are you?
Yes, sir.
All right, I'm over in Western North Carolina, so
Nice.
we'll chat more about that. So
That's right. We can have a barbecue challenge later.
there you go. We'll get out there and talk Buc-ee's. They just put one on the eastern side of Tennessee. I think it's the biggest one now. So if y'all have questions, I know there's only one person watching right now, but if as people join on, if you guys have questions, go ahead and ask them. If you're watching on the replay, let us know that you were here. If you're here live, of course, say good morning. We love to hear from you. Or good afternoon if you're like me and it's now 12:01 on the East Coast. Are you set your central time zone, Alexis? Because you're over on the western side, right?
Yes, sir. Central.
So I'm on East Coast here. So again, if you were watching on the replay, just give us a hashtag replay. Let us know that you were here. Always like to see that. And let's jump right in. What we're going to do today is we're going to do a quick rate recap and a rate forecast. Let you guys know what's going on with the mortgage rate market. There's a lot going on today that we want to talk about. And then Alexis is going to share with us some information about the housing market and inventory and all that good stuff. So let's see. I'm going to go ahead and add my screen to the stream, and let's go ahead and go to the stuff here. Again, if you're here live, say hello. If you're watching the replay. So when we talk rates, just remember this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. You always want to shop around, make sure you're comfortable with who you're working with and that you do shop your interest rate. But this will give you some idea of kind of what you should be hearing. So what has happened since last week? Rates have crept up just a little bit, not too much. You're on average, you might see maybe 0.125% or what we call an eighth of a point different. So if you were at 6.5, it might be 6.625, or you may be at the same interest rate, but you may have to pay a little bit to get that rate. So we've seen just a little bit of movement since last week. Mortgage rates, VA rates averaging still in the mid sixes, around 6.5, 6.625 is a good rate, depending on your credit score and some other variables. It may be higher than that, but if you're finding something in those mid sixes to the what we call the high sixes, 6.75, those are good VA rates. If for some reason you're not using your VA benefit to get a mortgage and you're using what we call a conventional loan, then you will find that rates are in the high sixes into the low sevens at that point. And again, that's going to be something that would be pretty much on your credit score, the amount you're putting down. The low sevens are very normal right now. So if you're seeing rates in the sevens, even though we don't like those rates in the sevens, that is a normal rate. So, but there is a lot to talk about on what is coming up next and kind of where we go from here and where rates are going to be. So today's a really big deal. I'm going to share with y'all some pretty graphs. And Alexis, you are, as my co-pilot today, you are the voice of the people. So if there's something that you have a question about, or you think that our veteran friends would have a question about, I would love for you to either interrupt me. It can be a little difficult, but I know you can do it. Interrupt me and ask, or I will throw it out there and give you some opportunities. But again, feel free. I want to make sure I'm explaining some subjects that can be a little bit complicated in a way that's simple enough that everybody can grab them pretty quick and on social media rather than needing an economics degree. Would you do that for me, Alexis?
Absolutely.
I appreciate that. So today we're going to have the Fed meeting. The Fed is made up of a bunch of different members. They meet generally about every 6 weeks. And in the last 11 meetings, they've raised the Fed funds rate, or what we call their policy rate, 10 times out of those last 11 meetings. And the last meeting in June was the first time in over a year, in about 15 months, that the Fed did not raise their Fed policy rate. Now, the Fed does not set mortgage rates, but mortgage rates, just like auto loan rates and credit card rates and equity lines of credit rates, and basically any lending, is based off of that Fed funds rate. It's kind of the starting point for most rates. And also it affects your savings rates. Y'all may have noticed that you're getting better interest rates on savings accounts and CDs. And that actually is also tied in when the Fed raises those rates. That's the plus side. The downside is that it costs more to borrow money. The plus side is that you get a little bit more when you're, basically providing it, depositing it, or lending it. So the Fed is meeting today. It's a 2-day meeting. They started meeting yesterday. It concludes today in about 2 hours. It's 12 o'clock Eastern. They're going to end at 2 p.m. Eastern today. And when they end, they're going to come out with a Fed policy statement. It's a prepared statement, and it'll be very similar to what they said at the June meeting. There'll be very small differences in some of the things that they say. They'll take out a word here or there. They might say that they expect to raise rates, 1 to 2 more times, or maybe they expect to raise rates once more as needed. They'll make little changes. And based on that, we're going to see traders react to that news. Stock markets are going to get a little bit choppy, and the bond market is going to get a little bit choppy today. And the bond market, that's the one that could be a little bit confusing. So this fancy chart with all these happy little candlesticks, as we call them, these green and red lines, as they go up and down, that's basically the foundation for where mortgage rates come from. And it's why you'll see mortgage rates that will actually change, not just day to day, but during the day, or what we call intraday repricing. So today we have a lot of risk of that repricing, meaning lenders have started out the day. They generally issue their rate sheets with rates early in the morning, around 10 a.m. Eastern time. They will generally say, okay, here are the interest rates today. And those numbers are based on these bonds and how they're performing and how much profit there is and all kinds of different variables. But they don't just make these rates up. They're based on this bond market and what we call universal mortgage-backed securities. That's what UMBS stands for up here. So today, I'll put this on a 1-day chart and I'll zoom in on this. So this is just a line chart of what is actually happening today. Let's make it a little bit smaller so it will fit. Okay. So today what you're seeing is that we've actually, when this line goes up, that's good for mortgage rates. Things improved heading into where lenders came out with pricing this morning. So interest rates today were about the same as yesterday. But if you had to put money into the transaction to get an interest rate, you might put a little less in today. If you were getting a credit from your lender, you might get a little bit bigger credit today. Things are a little bit better today. And right now we're kind of flat. You'll see that as these trade, they go down and up a little bit. And that's why you see all these jagged little up and down movements. They're actually trading in real time. Now, what's going to happen is in about 2 hours, we're going to see this chart go wild. And we're going to see 2 events today that are very important. We're going to see the actual Fed policy statement, which is issued at 2 p.m. Eastern time. And then we're going to see Fed Chair Jerome Powell, who is going to do a press conference at 2:30 p.m. So if you are currently in a transaction, you want to make sure that you're working with your lender, and you've talked about if you're locked in or if you want to be locked in. And this is really a personal decision and depends on your risk tolerance, how much room you have to work with, because if your numbers are tight, maybe your payment is right about that edge of what you can afford, you might not want to mess around. But if you do have a little bit of room, and if you are more of the gambling type, you may see interest rates get a little bit better today. But on the way there, we may see a lot of movement, and it's not always a straight line. So at 2 p.m., we could see a negative reaction to the policy statement. And then at 2:30, when Fed Chair Jerome Powell gets up and answers questions live, markets may say, oh, you know what? We actually like what he has to say. And we're going to, things are improving. So it can get a little volatile and a little confusing, but we'll kind of see where things settle at the end of the day. And mortgage rates, it's going to give us direction where mortgage rates go over the next couple of weeks. So for mortgage rates today specifically, we're looking at what we call Fed futures. And that's this fancy chart. I love to show this one. This one's free. You can watch this if you Google the word CME Fed futures, CME Fed futures, and that'll bring up a link called the CME Fed Watch tool, and that's what I'm actually looking at. And what this shows us is that today, July 26th, this is a Fed meeting. Our next meeting is on September 20th. The meeting after that is November 1st, and the last meeting of the year will be on December 13th. So after today, there's 3 more meetings this year. Today, markets say, hey, there's a 96.5% expectation that we're going to see the Fed raise their policy rate by 0.25%. So when the Fed raises rates, what happens to mortgage rates today? Well, a lot of people assume if the Fed raises rates by 0.25%, mortgage rates are going to go up by 0.25%. What makes this a little more complicated is that markets have already priced this in. Markets are anticipating the Fed activity rather than reacting to it. What we're going to see a reaction to today is what the Fed members have to say and what Fed Chair Jerome Powell says about the future activity. And that's why we see the reaction today, because markets are anticipating what the Fed will do in the future and reacting to it now. So this has already been priced in. When the Fed does raise rates today by 25 basis points or 0.25%, it's not a big deal. It's not going to hurt your mortgage rates at all. What we're looking at, though, is what do markets think is going to happen at the September meeting, at the November meeting, and at the December meeting. And right now, after the last meeting, the Fed said, hey, we think that we're going to need to continue to raise this interest rate in order to fight inflation. And that's why the Fed is raising this interest rate. By slowing down borrowing and slowing down the pace of money, it slows the economy. And when you slow down demand, that allows that supply-demand ratio to kind of equalize a little bit, which is why we see inflation start to stabilize. When you have more demand than supply, people are willing to pay more to get things. And that's when we see inflation go up very quickly. That's what happened post-pandemic. So we saw inflation rise because we had supply chain issues. We had people that had pent up demand for services and travel. People wanted to get out again. They wanted to go have fun again. So we saw a lot of demand and we struggled with supply. Well, we've seen that kind of equalize now. And if we look at the kind of the inflation, let's go ahead and go to, actually, I'm going to go to a different chart here. Let's see. We'll go to CPI, inflation data. So the Bureau of Labor Statistics, they're the ones who track the consumer price index, or the CPI. And according to this, we're going to click on this fancy little button that says chart. And I want to show you guys a quick chart here. So we're going to change to the past 20 years. And what this shows us is that in June of last year, June of 2022, inflation peaked at 9.1%. Everything was getting more and more expensive very quickly. Since then, we've seen what we call headline inflation coming down significantly each month. And at this point, at the last reading on, what was it, July 12th, it was 3%. Now the Fed wants to get it down to 2%. So we're pretty close on that. But we don't just look at that headline number. We also look at a number called the core CPI. What that does is removes the price of energy and food, because those are more volatile and gives us kind of a stable number to look at. And with this one, we've seen less what we call disinflation. So deflation is when the price of goods are actually going down. Disinflation is when we still see inflation, but it's happening at a slower pace. We don't want 9% inflation. We want to see a healthy 2% inflation. So right now we're at about 4.8% on that core number. And that is down from the month before at 5.3 and 5.5. So we are seeing an effect from all of these rate increases. We've seen a slowdown in demand. We've seen supply have a chance to catch up. So we're seeing inflation get a little bit better. But today, everybody's going to be looking at what the Fed has to say. And do they think that the Fed is going to raise rates? Like right here, this is a 35% belief in Fed probabilities that the Fed is going to raise rates again in November. So right now, what markets are really saying to us is they think that the Fed is going to go ahead and raise rates here in July, stay steady in September, skip a month like they did in June. And then most likely they're going to want to raise rates again by November. Now, today, we're going to get some clarification on that from the Fed themselves. They're going to issue that policy statement and Fed Chair Jerome Powell's press conference where he answers questions. And we're going to see how markets actually shift their expectation. If they believe, if markets start to price in the idea that the Fed is more likely to raise rates, we're going to see mortgage rates get a little bit worse from here. Not significantly, but anything sucks. So, they're going to be up probably anywhere from 0.125 to 0.250. So from what we call an eighth to 0.25%, you'll see interest rates possibly rise over the next, week or so. And it'll happen very quickly today. You'll see the first jump and then they kind of creep up from there. If, however, the markets believe, no matter what the Fed says, sometimes the Fed says they're going to raise rates and markets go, we don't think they can. If markets believe and have a sentiment that the Fed cannot raise rates, that this is going to be the last hike we see for the year, and that they think that the economy is getting into line, well, then we're going to see mortgage rates that are going to get slightly better over the next couple of days. And we're not likely to see rates get significantly better, y'all. I guess it's something I think everybody needs to hear and come to terms with, even though it's no fun. The reality is that the reason rates were at 2 and 3% were we were in a pandemic and nobody was out spending any money and everything was locked down and shut down. And the only reason we would ever see rates like that again is if we saw, terrible events like that again. More normalized rates are going to be in the fives, but we're not anywhere near that level. Right now, the economy, and as healthy as it is, a strong job market, we're going to see mortgage rates that are in the sixes and sevens for the foreseeable future. And they'll only start to come down again when we see the labor market weaken, which means people are going to have to lose jobs. And that's never a good thing. But that means that people don't have the money to spend. Our economy is consumer spending driven. It means that like housing prices. Let's bring Alexis into the conversation. And Alexis, let's talk housing prices. Everyone said rates have gone up. These housing prices, they're all going to come back down now. So how much did housing prices come down in your market, if at all?
Not really at all. Home prices are continually rising across the board. Now, granted, with real estate, a home is only worth what a buyer is willing to pay. But pretty much across the board, home prices are continuing to increase. We are noticing some price improvements, aka price reductions. However, they're still higher. They're not a significant drop at all. A 5,000 price drop on a $500,000 house isn't considerable.
Yeah. And are you finding instead of price drops, or you as an agent, do you ever recommend that somebody use a seller concession or a buyer ask for a seller concession?
Absolutely. So probably for about the last year or so, getting sellers to pay buyer side closing costs is definitely a thing. Again, I can't stress this enough. This will vary property to property. A hot property that everyone wants, still competitive, so will be harder. But yes, I am noticing an increase in seller concessions.
Okay. So, with that strong demand and
Mhm.
with home prices being stable, that's why we're seeing an economy that has actually been very resilient, and that's happening around not just with home prices but with a lot of goods and services. So because of that, it's kind of an equilibrium. We're at the ocean is smooth right now. We don't have a lot of waves and we don't have any storms on the horizon, and that's why mortgage rates aren't likely to go down anytime soon. Do you think now is a good time to buy a home, and why or why not?
I do think now's a good time to buy a home. You need somewhere to live. So you always want to make sure that you align with a home that suits your price point. However, I will err on this. Second homes, vacation homes, things like that, people are a little bit more apprehensive going forward. But especially within the military community, if you're PCSing, you need somewhere to live. So PCSing and the desire to buy at the next duty station, yes, I recommend, if as long as it aligns with your family's needs and budgets.
And why would somebody not want to wait until rates drop? Sometimes that's something that we hear from a lot of consumers, and it's a natural reaction. Nobody wants to overpay. There's a lot of fear that I'm making a mistake by buying at the top of the market, and I want to wait for rates to come down. And again, I'm the rate guy, so I say rates aren't coming down. And when I say down, I mean significantly. They always can go down an eighth or a quarter, but we're not going to see 6.5% and 7% rates go to 4.5% and 5% rates anytime soon. So with mortgage rates being where they're at, why wouldn't somebody wait until rates drop to buy a house?
Well, I will say this, no one saw COVID coming. We could not predict that. So we cannot guarantee rates will drop. You do not know. The best thing for a consumer right now is to be educated on the rates on the market, like what Helmer's providing here today. And again, fall in line with a price point that best suits your budget, because no one can predict the future. We can have all these forecasts and have this open discussion, but the reality is we can't predict the future.
Now, and I agree, because in fact, around this time, all of us, forecasters, the mortgage people, we anticipated rates would be lower than where they're at now, because the expectation was after all of these Fed rate hikes that we would see a recession, that we would see that spending has really dropped, the economy has slowed down, and unfortunately that also trickles into the job market. So all of this was supposed to, we're supposed to be knee deep in a recession right now. And I met a mortgage of mine. I met her during last night, and we were he was down from Philadelphia, so he's at this beautiful hotel in the Asheville area, and it's an upscale hotel. It's a beautiful hotel. And he said, Hammer, what do you think about all this talk of a recession? And what I did is I went like this. I had to look around. We were outside with a beautiful view of the Smoky Mountains, and there had to be 100 people out there, sitting at tables at the restaurant and in the lobby. There were at least another 50, 60 people. I said, look around. Does it look like people are not spending money? Do we look like we're in a recession? People can point to the numbers, inverted yield curves and all kinds of things and GDP numbers, but do we really feel like people are not spending money? Are people afraid to spend money right now?
People are still living their lives. That's the thing. You got to realize the pandemic, we were all hemmed up inside, and people are wanting to get out and enjoy life. Tomorrow's not promised. So I know for myself, my family, we're still getting out. We're going places. I am mindful of spending. I don't like the prices of gas and food and other goods. However, honestly, it hasn't really slowed down too much.
Yeah. No, I bought fast food real quick, and I don't buy a ton of it. So I actually bought something in a hurry yesterday, and I went, holy smokes, for me to get a burger, I didn't even get fries. I just got a burger and a drink. I'm like, it was like $9 or $10. I'm like, I remember when that was half that. You had the dollar menu. There is no dollar menu now. It's almost like the $5. It's like the $5 menu. So, do you think that there's an advantage to buying a home now? Do you see less bidding wars in your market, or that maybe homes aren't going for, like you said, as ridiculously high over asking prices? What is your market like?
It depends on the price point. So within every market, there are several markets that are based off price point. In my market, understand, again, I can't stress this enough, any home that is priced right, just has it all, the bells and whistles, will be competitive. However, just for a standard home, in my market, lower priced homes are typically competitive. We aren't seeing 12 offers on homes, but it's not uncommon to see 2 or 3. And even when there's 2 or 3, buyers are still able to get seller paid concessions.
Now, there are unfortunately some folks that say, especially even in the real estate and where they say, hey, avoid that VA mortgage. Other sellers aren't going to sell to you if you use a VA mortgage. What would you say to them?
First of all, let's slap them. Okay. No, we're not hearing that. Okay. So the VA loan is a strong loan. Do not let anyone tell you otherwise. It's the best loan, period. Hands down. And I've sold enough of homes with VA loans. All right. That's fact. But what you have to do is you just have to combat it with education. Here in Vetted VA, a lot of what you observe on our posts is education based with VA loan facts straight from the VA loan handbook. Highly recommend that your lender or your real estate agent also supports that same mentality, that they are leading with education.
Yeah. And that's where I think it's important that the professionals that you work with that can help combat that. And that's where there's listen, they call me Hammer because that's not the name my mom put on the birth certificate. It's the one I've earned through personality. So I'm as subtle as a train wreck. But there's a lot of people that say, why do I need a real estate agent? Or they don't realize what a difference it makes on what agent you work with, because the agent matters. And this is a situation that I think that really comes into play, because you as a buyer representative can help to combat that, on that selling side and the other side. Do you think that there's a role that the agent plays in that?
Absolutely. I prefer the approach of education. It's competence, and confidence often wins with VA loans.
Yeah. So that's awesome. Well, Alexis, is there anything that you want to leave everybody with as far as that you think would be valuable, last tidbit?
Absolutely. Stay positive and stay focused on the future in a positive light, regardless of what the Fed comes out today and says.
Yeah, because rates go up, rates go down. Mm-hmm. It's not going to be too much, it'll affect your payment a little bit. But if there's one thing I've learned in the housing market is that nothing's permanent. You do have opportunities for refinancing in the future. Let me find my little banner ticker here. We've got, the interest rate reduction refinance loan. I call it rapid because it just does happen so quick. The EARL, that is a VA specific mortgage refinance option that really, can help. So if rates do go lower,
Mhm.
Get in your house today that you can afford and enjoy the benefits of lower payment later. In the meantime, build equity, have a place to live, paint the walls whatever color you want, put in a swing set. It's have your own pets if you want them.
Mhm.
To me, owning a home is about so much more than just even the financial side. It's that personal side. That was always what I liked. So, but well, thank you. Let me see. I do see one comment. Let's just see. We've got some thanks. So thank you as well. Alexis, thanks for joining us today. I look forward to when we get to chat again next time.
Okay.